In this video we want to talk about accounting. More particularly we want to talk about the very rudiments of accounting. A very short introduction to the whole topic and look at some of the key points that are associated with accounting and for the rationale for accounting within a business. Clearly, a good accounting function is essential in the management of any business. If the business doesn't know what it owns or what it's making from its sales, what revenue it's receiving, or what its costs are, then that business is out of control. That business is not going to exist for a long period of time, if it exists at all, because it's essential that the business understands what its revenues are, what its costs are, what its profitability is. Its long-term survival depends on its profitability. The purpose of accounting is to allow businesses to keep track of their resources, not just their money, I suppose wider, keep track of their resources, keep track of their equipment, their work in progress, their raw materials, as well as their financial resources. But it's important that they should be able to pay short-term bills. They should be able to pay wages and salaries when required. So accountancy looks at various techniques that enable management to effectively run the business. For example, in the payment of essential short-term requirements such as wages and salaries, it may have a cash flow statement, which is the subject matter of other videos. But the cash flow statement will simply tell the managers what revenue is coming into the business and what bills need to be paid in the next short period of time, and ensuring that the business can pay those bills. So it's very important that a business keeps track of its wider resources and also in particular its money resources, its financial resources, because it will have to pay short-term bills as well. Accounting is all about recording, preparing and interpreting business transactions. That's what accountancy does essentially. It records the financial transactions of the business. It prepares reports for management to enable them to make effective decisions, and it helps to interpret what's going on in the business, the direction in which the business is moving, what's successful, what's costing too much, what is good practice, what is not so good. So it's a totally essential component of managerial control. It's very important for the management to be able to control the business, and it can only do that if it has appropriate information. The information is made available to people who need it, such as managers or the owners of the business. And the managers or the owners then make decisions to improve the performance of the business. They can only make those decisions if they know exactly what's happening, and also they can know they know the trends within the business. Are sales increasing, decreasing? Are they flattening out? Are costs increasing? Are costs increasing more than revenues increasing? So the decision makers need to have all of this information available to them to enable them to plan and make good decisions. Management accounting is used to monitor, plan and control the activities of a business. Now, to this end, we have to distinguish immediately between financial accounting and management accounting. Financial accounting is to do with the preparation of the financial returns of the business. These are important, for example, for the payment of tax. But it's also important that there is an accurate assessment of the size of the business and the performance of the business from a financial perspective. And that happens, generally speaking, once a year, when companies make their returns to the tax authorities, but also get a picture of their business in terms of its size and performance. Management accounting, by contrast, is to deal with the internal workings of the business. The management accountant looks at the costings inside the business. What's costing a lot, what's costing not so much, and what are the trends and the patterns of costs within the business. So management accounting will deal with more, if you like, operational considerations within the business. So management accountancy allows the business to understand how much profit they have made. So the management accountant will work out which parts of the business are most profitable, which parts are not performing very well. Do they have enough cash to pay the employees' wages? As I said earlier, there is one particular technique known as cash flow, which is very important to the management because it shows them exactly what financial resources they've got and what are their obligations within the next week or couple of weeks, to see if they're able to pay their bills. It's also useful to know what dividends can be paid to the shareholders. Sometimes when we deal with issues such as accountancy and business in general, we tend to forget that the businesses are owned by people, and it's important that the people who own the businesses get a return on their investment. If they don't, then they will not want to be involved with the business and they won't make investments in business. In fact, if the shareholders were completely ignored, then the business would cease to exist, because the owners would no longer be involved in the business. They would become alienated from the business, and if the business then wished to raise additional funds, perhaps for an investment project in the future, the shareholders would not be there to finance that. So it's important that the shareholders get a dividend, and the dividends must be in line with the risk and the uncertainty that the shareholders have taken on board when they set up the business. It must also have some reference to the returns that are available in the wider economy. For example, what are the returns on investments put into the banks or into government bonds? Because if the shareholders can get more from those returns, then they may wish to get out of the business, to take their cash out if possible and reinvest it elsewhere. So it's important that the shareholders are paid sufficient to keep them engaged. It's also, of course, important that the business generates sufficient funds for expansion. Businesses tend to operate in very dynamic markets where customer requirements are ever changing and there is increasing pressure of competition from abroad because of globalization. So businesses must constantly look to renew themselves and also to expand, perhaps expand certain areas of production and perhaps cut back on others and invest in new equipment. So it's important to generate sufficient funds to be able to finance that. So if we look at accountancy as one activity, then we can start to split it up into what it does in practice. So for example, we would see financial accountancy coming away from this broad heading, just say accounting, financial accounting would come away from that. And this would look at areas like cash flow statements, like I mentioned earlier, but it'll also look at the balance sheet and the profit and loss account and look at income statements. It's important that the company report accurately on their performance and report profits honestly and openly so that the tax authorities of the country may levy appropriate taxes. It's also important, of course, that the business is properly valued so that the shareholders know how the business is doing. So financial accounting is very important. It deals with the financial status of the business. So it looks at the financial performance of a business and targeted at external users. For example, shareholders, lenders, suppliers, customers, and the government. So it's looking at the external users of this information. Now, management accountancy, by contrast, as I said earlier, will look at cost information. What parts of the business is costing more than others, and is that a justified expenditure, or could it be reduced in some way? So they're looking critically at costs. They're also helping management to make decisions, where to expand the business, where to contract, how to reorganize the business. They're looking at the much more internal runnings of the business. So management accounting looks inwards. If you like, financial accounting is looking outwards. So management accounting, it's intended for internal use of a business in order to make the right decisions. So management accounting is it's a management aid to decision making. Now, management accounting, well, cost accounting. Cost accounting includes costing as a basis for pricing and stock valuation, planning, control and performance in terms of future costs and how to monitor them using budgeting and standard costing methods. So cost accounting is looking critically at stock holdings. Is there a way of reducing the burden of stock holding? Because investments in raw materials and semi-finished goods is really dead investment. It's not doing anything for the business until it's brought back into production and completed and sold. But before it's sold, it's just lying idle. It's an investment in a sense that's not doing anything. So it's important that the cost accountant look at this and work out the costs involved in not just stock holding but all parts of the business. There may be machines standing idle or that are not being used optimally. Decision making includes short-term decision making, for example, looking at break-even and contribution analysis. In other words, looking at how much the product is being sold for and what proportion of the revenue generated can go to pay the overheads of the business, as well as pay the costs of production. But also looking at long-term decisions, looking at strategic management and capital budgeting and long-term finance, because the business must plan ahead. As I said earlier, the chances are the business will be operating in a dynamic environment, one which is changing because of customer expectations and preferences and increased competition. So the business must plan ahead. And again, it can only do this if it knows it's got the financial resources to play with, to use under those circumstances. Cost is the amount of resources, usually measured in monetary terms, sacrificed to achieve a particular objective. This overlaps with what economists talk about in terms of opportunity cost. So when the company makes an investment in a certain area, then that resource, if you like, that money is used up and is not available, therefore, for some alternative piece of investment. So the management must always look at what they're giving up. When they make an investment in one area, they can't make an investment in a different area. So they must decide which one is best. And to do that, of course, they need accurate information, and that comes from the cost accountant. So the objectives may be, for example, if we can just move it to ourselves for a moment, maybe to buy a car, to buy a house, make a particular product, or perform a certain service. It applies to everyone. When we buy something, we use our resources to acquire that product, but therefore the resources are no longer available for us to buy another product. So the cost of the product we've bought is the one that we didn't get, which is known as opportunity cost. And the same in business. The business may decide to invest more in cars for the sales agents. And if they invest more in cars to get the sales agents to meet the customers, then the company will not have that financial resource available to them to invest in machines or to invest in training programs for the workers, because it's been used up. The aim of a business is to make a product or service is to attract customer attention, such as the public or another business. So the business is constantly trying to produce products that are attractive in the marketplace, that are going to be successful, that are going to sell and generate revenue. But it must do it efficiently, and to that end it must constantly scrutinize its costs. The more people that buy a product or service, the more profit the business will make, generally speaking. The more the people buy the product, the more contribution the business is getting towards its overheads. And at some stage, the business will break even. There will be a certain critical amount of sales at which point the business breaks even. It has covered all its direct costs, the cost of the raw materials, the cost of the labour who's made the product. It'll also have received a contribution because of the markup on the product. It'll have received a contribution towards the overheads. In other words, towards the premises, towards the machinery, towards the marketing department, towards the HR department, to all of the overheads of the business. So it'll have received a contribution to those, and at that stage it will go into profitability. All the costs of the business will have been covered and the business will be in profit. It's important for any business to control its costs and increase its profits. It goes without saying. It must control its costs and it must increase its profits, because businesses exist in competitive environments. There are other businesses who will only be too happy to take the customers. So businesses must fight for their position in the market. They must have good marketing campaigns, which costs a lot of resource. It costs time, effort, money. So it must be able to finance those, and it must generate the resources to do it. And of course, the more successful it is, the more profits it will generate. Now, the classification of costs. Well, the main cost in a business, or the main costs, I should say, in a business include material costs, including the cost of obtaining the materials, receiving them within the business. The cost of having the materials brought to the business, by the way, is known as carriage inwards. So it's getting the raw materials and paying the carriage inwards, paying for the delivery to the business. But businesses, particularly manufacturing businesses, obviously, will have material costs. Service businesses may have some consumable products, for example, paper, ink, printing machines, perhaps a local area network. Depends on what it uses. But there will be material costs that need to be acquired. Also, labour costs. These are the costs incurred in the form of wages and salaries. And there are also related employment costs. For example, companies have to ensure health and safety, and there may be pension and holiday entitlements, maternity pay, and there are various other payments that businesses must factor in terms of its labour costs, but it must be prepared to pay those. And expense costs and overheads. These are external costs such as rents, business rates, electricity, gas, postage, telephones, and similar items. And these will have to be met as well. They're a cost, and the business must pay those, otherwise it won't run effectively. So we could classify costs under various headings, and here we've just got 3 headings. If we spent more time thinking about it, we could perhaps generate more headings again, or we could subdivide these into different classifications. So in this session we've talked briefly about costing and budgets and the classification of costs and the importance of financial accounting and management accounting. And that's all we're going to deal with in this session, so let's leave it at that and say thank you for watching.